I want to talk about banks. My next guest says banks are not out of the woods yet, and the reason, commercial real estate. Matthew Anderson analyzes bank loan data at his firm Foresight Analytics, and he joins us live from San Francisco. Thank you so much, Matthew, for being with us.
Good morning.
Okay, so, you know, the guys and I have been, of course, watching the bank profits. And if you looked at the profits themselves, I mean, investment banking, trading going up, it seems as if the banks are doing very well. But you're saying that they're sitting on, of course, all these bad assets in the form of commercial real estate loans.
That's right, yeah. Commercial real estate is generally being viewed as the next shoe to drop. We think it's really already dropping. And write-offs there have been considerable, but we think that the banks are generally only about a third of the way into the write-offs that they need to take on commercial real estate just to get caught up with where the non-performing loans are right now.
Well, Matthew, we hear that a lot. Commercial real estate, you know, may be the next shoe to drop. But can you quantify that for us with your data?
Well, there are about $110 billion worth of commercial real estate mortgages in default right now on banks, just on the banks' balance sheets. And the banks have only written off about 30 or 40% of what we think they need to write off just to get caught up with that $110 billion. And then looking forward next year, we think there's probably another easily 50, 60 billion of additional defaults coming online, so there will be more loss provisioning needed there.
So ultimately, Matthew, for those who have invested in bank stocks over the last 3, 4, 5 months, you were saying what?
We're not out of the woods yet. Definitely, there's a lot more loss provisioning we think that needs to occur. That's been a drag on earnings, and we think will continue to be a drag. The other thing that we've looked at a little bit, we don't focus on as much, is the lack of interest income. That's what we consider really core earnings for banks, as opposed to the investment banking revenue, which is very volatile. And we think the market is pricing in that volatile trading and investment banking revenue more highly probably than we would. And the lack of interest income is a concern. Although if interest rates rise a little bit, that'll probably help banks out.
Hey, Matt, let me jump in here. It's Adam. Look at General Growth Properties. Obviously, the stock in bankruptcy, but now up from 50 cents, trading $5, trades a couple million shares a day. People are trading this thing. Does that perhaps offer a template for what might happen, negotiating with bondholders?
It could. Actually, our view on the REIT market is that it's very interesting. It can be a predictor of prices on the private side. The REIT market, of course, a year ago had really taken a hit, and that turns out to have been a predictor of what happened on what we call the direct or private side in terms of pricing. Now REIT shares are up strongly. Who knows? That could mean that real estate pricing will come back a bit.
Okay, Matthew, we'll have to leave it there, but thank you very much for joining us. That was Matthew Anderson of Foresight Analytics.